Welcome, everyone. My name is Abhilash Mishra. I am the founder of Equitech Futures. I am a Caltech alum, and this is part of our collaboration with the MIT Alumni Club of San Diego around a series of talks and seminars around innovation and global science and technology. And this particular talk is going to be around reimagining venture capital and funding for innovation. And I'm really excited to have my colleague, Linda Kinning, join us. And Linda will be leading us in this conversation. And as always, we want this to be interactive. So please feel free to unmute, ask any questions in between. We'll try to make it more of a podcast style conversation as opposed to just us talking to you. And so with that, I'm going to hand it over to Linda.
Great. Thank you. As Abhilash mentioned, this is a conversation. So we're going to share some thoughts. We're going to talk to and with each other and certainly with you all. So we'll be keeping our eyes on the chat, but let's jump into it. We can start this talk by telling you a little bit about ourselves, and we certainly will. And we can talk about the degrees that we have and the institutions we're affiliated with. We have Caltech, we have University of Chicago. We've got a lot of connections. But I think the thing that is most important is to tell you what we do. And why this conversation is meaningful and important, why it's something that we talk about. And that's because we both worked for and with and bringing to life Equitech Futures. That is the company that Abhilash founded. It's a global fellowship and innovation lab that trains the next generation of technologists who want to solve societal challenges. And we've been around for going on 5 years. And the real thing that holds us together, our strong mission, is believing that innovation thrives in networks. And what is our role? How can we design networks that bring together the best of global talent, that bring together science and technology to solve really, really meaningful problems? And we do that through our Equitech Institutes, our curriculum learning programs. We do those remotely. They operate all across the globe. We do that through direct venture building. So I'm the director of our venture studio. We work with founders who have ideas, and we prototype and we build things. And then we also recognize that the importance of in-person connection, that we can have these amazing digital networks and they're strengthened by physical in-person gatherings by using our social networks. And so we do this selection of global convenings. And through that, we've been able to build an alumni and student network of over 250 young people armed with technology and data science skills in 56 different countries. And we have a faculty network at 10 right now, always growing, who teach data science, who teach science communication, who teach entrepreneurship. And I would love to talk about us all night. But the question that is bringing us here is about venture capital. And so while we work with entrepreneurs and we do investment and we work in innovation, we work very closely with venture capital. It's in our ecosystem. And that's the conversation I want to have today. I don't have VC next to my title, but it's very much in my network and in the world. And so I want to start with what do we mean when we say venture capital? And I think the definition that I like, one of the best, I think we should listen to how venture capitalists describe themselves, comes from the chairperson of Kleiner Perkins, Caulfield and Byers, very, very big VC that says venture capital is all about helping entrepreneurs make the world a better place. And this catchphrase is both resonant and aspirational, and at this point is also a little bit parodied. There's a whole HBO series, Silicon Valley, that riffs on this line about what are we doing? We're making the world a better place. But there's a reason we keep repeating it. It's because it does feel meaningful and it feels important. I work with young people all the time that we want to do this. And so this conversation is to say, how can we do that a little better? But I want to tell you, by way of introduction to who Abhilash and I are, about the ways that we have tried to make the world a better place. Because venture capital is one option, but there are many, many different levers. So Abhilash, I want to ask you in conversation, what are some of the ways that you've tried to make the world a better place?
Yeah, so I should by the way, begin by saying I never thought of myself as an entrepreneur growing up. I grew up in India. I grew up in a small town in India, and I kind of saw the first wave of capitalism take, have a real tangible impact. When I was growing in the 1990s and the early 2000s, that is when the Indian economy had kind of opened up, and that really led to a massive gain in the living conditions of literally hundreds of millions of people. There's something that a lot of people don't recognize as to how just rapid that growth was. Just to give you a flavor of numbers, my parents were both teachers at local colleges. They saw their salaries grow by like 5 times, so 5x, in a span of 10 to 15 years, purely because of the fact that the economy grew so fast. And that's where I kind of I got very interested in thinking about talent and allocation of capital to talent, and also about education. Education was something that was very close to me. So in fact, before I started at Caltech, I'd founded an education nonprofit in India, which was training young undergraduates to teach science and math in local low-income classrooms. I was trained as a physicist. I got my PhD in astrophysics at Caltech. And after Caltech, I realized I was really interested in working in technology education and supporting early stage innovation, which kind of led to the founding of Equitech Futures. And the way in which I would describe myself in a line is I'm an educator and I love supporting early stage entrepreneurs.
Right? Thank you. And I think for my part, I similarly, if I could go back in time and talk to my younger self, would not have described myself as an entrepreneur. That felt like a path that other people who I certainly didn't know or would have access to would choose. And so started my career as a theater educator. I thought, yes, education, that's the way to change the world and make it a better place. Burned out a little bit. I thought arts more broadly, storytelling, this is the way to change the world. Tried that in higher ed, worked at University of Chicago for a while, deep respect for educational institutions. I found myself a little bit like there's something else. There are other levers that I haven't figured out yet. And I got my MBA at Chicago Booth, focused in entrepreneurship, behavioral science, and strategy. And that opened up so many things. And the levers, the other things I was able to have access to, took me to Silicon Valley and Tokyo, working in a series of directly with ventures and some corporate-backed venture studio models. And now I get to work with that venture innovation with more of an investment side. So when I think about what are all the ways to make the world a better place, we have many different levers. VC is one, innovation, education. There are lots of those things that we bring to this conversation. And we come back to that question of how do we make the world a better place? How do we solve these problems? And this is an image that always comes to mind when I think about how's VC doing? What are we doing well? What needs to be better? And this is a map that shows early stage VC investment per capita. And what we see here could be a map of privilege and existing money. We see a lot of investment in the US. We see it on the coasts. We see it in Silicon Valley. We see it in New York. We see it in Europe pretty significantly. There's a lot of blank spots on this map. And when I think about the world, when I think about problems, when I think about young entrepreneurs and talent, that is globally distributed, but our capital map does not reflect that. And when I think about where talent is, if you ask any, especially early stage, we tend to work with a lot of early stage seed funding work. And we ask seed investors, how do you invest? Where do you find ideas? What signals to you? Something you'll often hear is like, I'm investing in the person. The idea, we'll see. But I'm definitely investing in the person. Where is that talent? And they're often looking for young people. We're looking for gritty. They're looking for people trying new things, willing to take risks. But when we look at the map of where young people are in the world, it's not in the US. There's a lot, but we see the vast majority. And when we look into the future, it's going to be in Africa, it's going to be in Asia. And so, how can we be more proactive in harnessing that talent and lending our capital in a way that can really invest in where this future talent will be located? And before we get into reimagining what VC could be, I want to take a second to say, what does VC do really well? There's a reason. There's a lot of money, there's a lot of influence, and there's a lot of excitement around venture capital. And it's because VCs are really good at funding high risk investments. VC as a form is still relatively new. We've gotten 20, 30 years, a few decades, but really good at finding first time founders, and the appetite for unproven business models. We see VCs being really good at accelerating growth, taking a company that has promise, maybe a few thousand users, and like putting rocket fuel on there for user acquisition and adoption, taking things that really scale. Networks and expertise that by sector and phase. There's a reason if you look on LinkedIn, young founders are putting who they're backed by, they're putting where they intern, they're using that as the same social collateral and social capital that they use to talk about Harvard, MIT, Caltech, Stanford. And that's really good at attracting talent. As VCs have built up their public profile, the talent attraction has followed that. And they're also, to be specific here, really effective at growing SaaS products. That's where we've seen the most growth. We're very good at it. We have a lot of SaaS products that have been grown by VC investment. But there's also things that aren't working. And I hear this certainly from some founders, but I hear this from VCs themselves, who say, "Ooh, there are some things that are working really well, some things not so much." When we look at the markets, when we look at the data, when we look at performance, there's some real opportunities for improvement here. Like any good investor, I wanna poke holes on both sides and do my due diligence on VC as an industry. I think this first point, and the data is very clear, is that the majority of venture-backed firms in the US do not return investor capital. Investors know that they are going to lose most of the money that they invest. And they're really trying to hope for that one unicorn that'll balance out the rest of that return. I think that begs some question of how we're allocating capital. We also get, anyone who's paying attention to the news cycles the past few years, we see these hype assets, Bitcoin, crypto, prime examples, where we look to the markets to indicate value and performance and where talent is. But we're also seeing some artificial inflation. There's the crowd group think phenomenon that loses a lot of money. We see overcapitalization, where because of these incentives, we get inflated valuations. So we get companies who are getting more money than they actually know what to do with, which sounds like a good problem to have until it happens across the entire industry. When you start seeing these market correction fails. I think you can see a snapshot from the bottom from TechCrunch of this valuation that was once at 22 billion. This was like the biggest, one of the biggest startups in India, down to zero. Where did that money go? We should be paying attention to some of those signals and saying, "Ooh, we can do better." This reads like a long list, but I promise there's some upside there. The flow of capital often reflects social inequities. When we look at who's getting funded, we will see the same things that we see in the biases in society. Black women, chronically underfunded when you look at the data. We see this extending for people of color. We see it for regional variance, and especially when we zoom outside of the US, we see these big differences between global South, global North. And if we think we can make the world a better place, that's something that needs to be addressed. And we also, the flip side of what VC is really good at is this hyper growth. So in some ways, we optimize only for massive growth, user acquisition. And I want to argue that there's other ways of success. In VC, we tend to get this myopic view. And then the last point, we do need other things rather than software. Software is great. It has eaten the world. And I think we need something else on the table. But what are the alternatives? And I hear this from students, entrepreneurs all the time. They'll be like, cool, I have this great idea. How do I get funding? Where do I go for funding? And that's a very big and important question. I think my response is often like, let's try to get customers first. But this question of like, where does the money come from is topical, super relevant, it's super important. But the option set is VC, which comes with all the things we just talked about, or this list of short alternatives. Go to your friends and family, which works if you have wealthy friends or family. That cuts out a lot of people. There's the option of a small business loan or maybe debt financing. One, it's very hard if we talk about just the US, it's very hard to start a small business in that way. They're not willing to take a lot of risk. But when you zoom outside of the US, this super risky and not that available. There's crowdfunding, there's bootstrapping, the sort of just keep trying harder. And we can look at some of the data on this, like small business loans, as sort of like other modes of entrepreneurship. We're seeing some rates of decline. But I think the most striking thing in this is actually the data that we can't quite measure, which is the entrepreneurial dropouts. Who are the people that could have been solving these problems, that could have been making interesting businesses, that could have been making meaningful financial returns, who were never given the opportunity, who we never see? And I think the position Abhilash and I are in at Equitech is like, we work with young people all the time who say, I'm not an entrepreneur because I have some idea of what that looks like. Or no one has ever said, hey, you could do this. And when I think about those people, this risk of the entrepreneurial dropout, I think of a young innovator we have right now, Sam. Sam studied computer engineering and computer science and engineering in India, recently moved to the US, young college grad, very smart. She came through our Applied Data Institute, a really rigorous 10-week applied data program, and repeatedly told us she did not see herself an entrepreneur. Interested, and maybe in a few years, but like too risky. I had no mental model of what that looked like. And she is currently, after many months of access, mentorship, and opportunity, apologies, is currently the technical co-founder of one of our companies called CAA, that we hear lots more about. Abhilash, I'm going to ask you if you have anything else to share about this one.
No, I think one of the things that we talk about in the Caltech and MIT context is there's this missing Einstein's problem, right? So where are the next generation of amazing scientists, and how can Caltech and MIT try and identify them? I think the same missing Einstein's problem exists a lot in entrepreneurship. What about the type of entrepreneurs who just never make it to a Caltech or who never make it to a Stanford? I have an interesting anecdote here. I was talking to John Hennessy, who was the ex-president of Stanford. And one of the questions I asked him was like, Stanford has such a massive endowment. Why doesn't Stanford increase the number of undergraduates it takes in? And he said, well, that was actually something that he had proposed to the trustees, saying, hey, we should be really expanding the number of undergraduates coming in. But the trustees and the faculty said, no, we are not ready yet. And like, we cannot grow the number of students just yet. And I think there's a fundamental conservatism in a lot of major leading institutions. Like if you can imagine if Stanford is conservative about growing the size of its undergrad, I mean, what hope do other institutions have? And so I think and this is creating a fundamental problem where the rate at which the number of students served by top institutions like Harvard and Stanford and MIT is not growing at par with the supply of amazing talent from around the world. And what do we do in that case, right? And I think that kind of ends up that is going to lead to this missing Einstein's problem in entrepreneurship and innovation, which is saying there are lots and lots of amazing entrepreneurs and innovators that the world is missing out on purely because they are not coming to a Stanford or Caltech.
Thank you. So some of the questions we've been asking ourselves is how might we find more efficient, effective allocation of capital? How might we give entrepreneurs more options to innovate? Our higher ed institutions are doing a great job at what they do. They can't do everything. What are these other places? And how can we, as citizens, as people of our society, as leaders, give ourselves more tools to solve these big problems? And so here's some of what we're experimenting with. And as we said from the beginning, this is a conversation. We are deep innovators, we're experimenters. So these are some of the things that we're working through. And this first is a model that we sort of briefly introduced at the beginning, which is the venture studio. For those who may not know, this is a form of bringing in talent, having a structured platform community, a playbook for venture building to de-risk both entrepreneurship for founders, but also the market risk of unproven ideas and say, how can we prove them quickly, efficiently? And for us, it's also how can we invest in our alumni talent? And we build off some of the things that we've already done well, a product-focused innovative curriculum that really builds on computation, data science, and AI, but really looks at systems, intersectionality, ethics, social responsibility. And we give access to our world-class networks. So when we work with founders, we're connecting people from many different countries. We're giving them access to both that global scale and global leadership. And we select for operator first mindset. Something I love about working with deep science people is we can take them, we get our deep expertise, people who love turning the problems around in their heads, and pair them up with doers, people who want to do things, build, put things into the world, be a little messy. And like that combo of deep technical domain expertise and the willingness to try and experiment is that sweet sauce, that sweet spot for entrepreneurs. And so I want to share a little bit about what that looks like for us. And so this is a company that's in our portfolio. It's early stage. We have users. We are pre-revenue. It's a company called CAA. It's out of South Africa. The two founders that we've been working with for about the past 6 months who have made tremendous progress in that time. They started with the idea that hiring, especially for entry-level jobs, isn't really working. It's not working for candidates who feel like they're sending a ton of applications in, they're not getting anything back, it's demoralizing. But the insight is that also employers aren't very happy with it either. Employers are saying, wow, I can't get good talent. So their innovation, their insight was to try to make a video-based WhatsApp chatbot interface so that you're not measuring people just on CVs or words that are scanning resumes, but really saying, hey, fill out this video assessment. Tell us who you are in your own words, in your own plain language. And what we're finding when we really put that in front of people is a lot of success. I'm going to play this briefly.
A very new yet refreshing experience for me. I did find that the process was a lot less nerve-wracking, and I put that down to some pressure being alleviated by me being in the comfort of my own home and conducting the whole interview on my phone. The interviewing process was pretty easy. I think, everybody sent the right details. It was very quick, easy, simple. Instructions were sent in a very thorough way, very easy to understand.
I think the screening process is honestly the best because CVs and seeing someone on paper is one thing, but having them live and speaking to you over the phone during the screening process is really when you get an essence of the person and whether or not you can see this person obviously being a part of your brand and a part of your company, really just being an ambassador and working under you.
And this is progress that, again, has been made in 6 months' time.
What
And
I
when we
also like, just as a kind of highlight of what I think when we say, innovation thrives in networks, this was an example of a founder, Ridwan, who was from South Africa, did not have a technical background, but had a deep operational product understanding, an understanding of business relationships. And Sam, who was technically very savvy, but did not quite know where to apply her talents. And so being able to bring in someone who is product focused and technically focused together, being in different continents. I don't think Sam and Ridwan have ever met each other, but the kind of good thing about this world we live in is you can build these networks and allow new ventures and new products being built, which I think is a very interesting bet to make when everyone else kind of says, oh, the only way in which you get to be an entrepreneur is move to Silicon Valley, right? That is a way of doing things. I don't think that is the only way of doing things. And I think that's what makes this experiment interesting.
Yeah, thanks for that color. Similarly, another company in our portfolio is measuring carbon. This came from the insight of some of our deep scientists, and Nikita is a geologist, I believe, by training, deep into carbon emissions science. We had Ronak, who was very interested in climate sciences, of pursuing a master's, and they met through one of our institutes and came upon this insight, this opportunity that there's a lot of carbon emissions data gathered by NASA and other sources, but it's not really user-friendly. In fact, it's actually really hard to access, and you need a lot of people, and you need a lot of time, and you need a lot of technical expertise to do anything with that data. And so they came together to create Measuring Carbon, which is a platform that visualizes and integrates all of that data so that policymakers and researchers and climate scientists can use this more effectively to really make their claims and recommendations on carbon that much more effective and to be able to communicate that better with the public. And so while we are building out a portfolio and we're seeking out investment, we're funding some of our own things, this question of what are these other approaches keep coming up. And so I want to share with you a few seeds that we are thinking about of this new approach to what we're calling right now people-centric capitalism. How might we use our money and time to yield both financial returns and social returns? Because so much of our work and also just our other backgrounds, we see deeply the role of philanthropy, of education, of institutions whose purpose is not solely to make money. And we also see the really powerful benefits of capitalism. And how can you align market incentives? And I think, speak for myself, these things don't seem to be working very well for a lot of people. And so what else? How can we tinker? So these are some of the things that we are looking at. I think some of this insight comes from typical philanthropy is unidirectional. You have funders who have money, they give them to nonprofits, you get some social return. If you want more social return, you have to go back to the same funders and say, please give us some more money. There are some things for which I think this is the most effective, ethical, expedient way. I think of things like hunger. We need people to get food. We get the money, get people food. We get those good social returns. When we think about good investing, what we aim for is this virtuous cycle. Investors invest money, capital, into founders and companies. We get market returns, and that money goes back to investors who can then repeat this cycle. The cyclical nature, this double feedback loop is the thing. Ooh, how can we get more of that? How can we get that cycle and combine it with some of this best of both worlds? And so one of the things we're toying with is this role of the philanthro capitalist, working title. Would love to hear your thoughts, drop it in the chat. But if you talk to classic VCs, investors, they will tell you right off the bat, I'm going to lose money. I know that in my portfolio, they're not all going to win. I'm going to lose money. I think one of the questions I'm sitting with is how can we, if we know we're going to lose money, how can we lose money better? How can we lose money in a way that still gets us some kind of return, even if it's not financial? And so a model that we're exploring is if we can get the right people and the right incentives who say, yes, I want to give capital to global leaders, to young people, to talent. And if nothing else happens, we still get social returns in human capital. Think about like university philanthropies. If nothing else happens, if we lose money at the end of that cycle, we get really amazing young people who know how to identify problems, know how to solve them, maybe build something later. But we also hope we play our statistics right. If we build our networks and our mentorship and our access to capital right, that some of those global leaders will make companies, and that some of those companies will have market returns that can go back into this cycle. Abhilash, anything to add here?
Yeah, I mean, I think one of the other ideas is in terms of timelines and time frames, right? So much of venture capital, something that we keep on hearing over and over again, is this hockey stick growth, the growth that is extremely fast, and that's what a lot of people look for. Whenever we talk a lot with venture capitalists, they're like, we always say we're looking for sustainable growth, and you almost see them kind of cringe a little bit because they're like, no, we are here to do like unicorn hunting. Now unicorns are not real, and so and which is why I think it is important for us to also recognize that a lot of the companies that are getting formed, not the vast majority of them are not going to be unicorns. But which means that we should really be thinking about like more realistic, stable, sustainable growing companies over a longer period of time. And that I think is a place where philanthrocapitalists can really play a role, because there the kind of time horizon for investment is slightly longer than a venture capitalist, a typical VC fund. So if you have a typical VC fund, which is say around 10 years, most of the capital needs to be deployed in the first 4 to 5 years if you want to get like the kind of returns that you're expecting, or 5 to 6 years, say. And I think there's a real kind of mismatch in that time horizon versus how long it actually takes for most companies in the world to take off. I mean, think about the biggest companies in the world like Amazon, things that took a long period of time to take on. Things like Facebook and Google are really exceptions. Like the vast majority of companies actually take much longer. And I think the time horizon for VC and the time horizon for these companies growing, there's a fundamental mismatch that we really need to reconsider.
Yeah, and I see some comments in the chat here, Paul. Thanks for dropping this. I don't know San Diego TL fund, but I want to look it up. But the T1D fund, this like venture philanthropy. For those who don't know, it's a fund specifically set out to address breakthrough cures in type 1 diabetes. I love this model. I don't know a ton about them exactly. I really want to learn more. But this model is saying we have a very clear thesis, the very clear outcome. How do we get there? We know the end point. We want to have breakthroughs on type 1 diabetes care support, diagnosis. And how can we incentivize, build the networks, have capital that say, hey, funders, founders, entrepreneurs, here's the challenge. If you do this, we already have built-in distribution, we have customer relationships, and we have capital. Like, I want to see more of those things. So I don't know evergreen corporate funds. I think when we say like reimagining venture capital, there are a few things doing this, and I'd love to hear more. Please drop them in the chat.
But we also, yeah, I think Paul might be referring to something that you have expertise in, Linda, which is like corporations starting to incubate like venture capital internally, which I think, we've seen this, and you have seen the challenges and opportunities in that space. So maybe that's what you meant, Paul, about like, corporations themselves having kind of venture funds associated with their balance in their balance sheet.
Yeah, so specifically by an evergreen fund, you're looking at one that's not a closed fund with a 10-year horizon, but where they're just annually allocating a certain percentage to the fund to address some of these timing mismatches for their corporate strategic objectives. And the T1D fund is a venture philanthropy fund that I had experience with that funded Capillary Biomedical, my company. The TL fund is a new San Diego specific fund that I just heard about here in January. So that was looking on providing a venture philanthropy for the San Diego community. It's the first one I've heard about at that community level, which I thought was really interesting.
Ooh, I love that. San Diego. All right, you're really popping up on the radar here. I think those are great examples. I want to see more models of that. And I think, to like put it into perspective a little bit, it's like there's so many venture funds that follow this like pretty classic, like maybe I'll put it this way. The Silicon Valley model of VC is so dominant that it crowds out some of the space for other models that look a little different. I can speak, a tiny bit to this experience. Is like I'd worked in Palo Alto, worked in Silicon Valley, and then I went to Tokyo to try to build some venture ecosystems there. And one of the mistakes I kept seeing was people saying, oh, we want to try to build venture, so we're going to do it exactly like California. We're going to do it, how can we take that exact thing? Without taking into account local context, noticing some of the things that didn't work. It made some weird decisions of saying like, oh, every playbook, we can just use Uber's customer growth acquisition, while people in the US were watching and seeing like Uber is not making any money at all. And the capital systems in Japan looked really different. There's actually a lot of government investment, but that wasn't, as interesting. It didn't fit that Silicon Valley style. Yeah, government-backed funds are absolutely a different beast.
And I should also like add in some ways, right? I mean, there's also something cultural that goes on in if you want to be an entrepreneur, the first destination is you go raise your big venture capital fund, from or your first round from Sequoia or what have you. Many people will not even consider the fact that you can apply to the NSF seed fund, which is non-dilutive and can actually and has allocate significant amounts of capital. And again, part of that has to do with cultural things where most emerging entrepreneurs that we talk to, they're like, oh yeah, I'm the only way in which I can start a company is go apply to Sequoia or Y Combinator. And they are extremely successful venture capital funds, but also Y Combinator, if you look at the statistics of who has succeeded in Y Combinator, these are typically B2B SaaS companies which have already acquired about like 100 plus customers. It's highly unlikely that something like Kala or Measuring Carbon that we have in our portfolio would get into YC at the earliest stages, just because of the kind of mismatch and fit.
I think another, and I don't have a slide about it, but Paul, your examples were reminding me of the Zebras Unite co-op fund. They sort of started as a movement, sort of antithesis of unicorns, and have now built this co-op model of funding founders. So I think there are some experiments here. I want to see a lot more. And love this question, Allison. Do grants have a role in this philanthropy? Yes, I think the short answer is absolutely. I think we see these, and Abhilash mentioned it a little bit. It's like there are some government grants. Finding them is really difficult. It is not actually that user friendly, and so I think a lot of people miss them. Large foundations are certainly doing some interesting things here. So I think it's absolutely a part of the role. I think one thing I would like to see on the founder side is that these things are available. I think the default pattern is so easily, I am starting a startup. That's what I'm calling myself. I need to go to venture capital. That's who gives people money and validation. And so part of it is like breaking up some of the mythos of that.
Yeah, I just want to kind of flag two examples. So Tyler Cohen, who's a famous economist, he runs this institution called Emergent Ventures. They funded us in the past. And one of the things that Tyler really likes to do is basically do a quick vet of talent and then give grants at earlier stages for people to start new companies. And these are not massive grants, right? So these are somewhere in the kind of 50,000 to 100K ballpark, or sometimes even less than that. But this can be catalytic, right? In terms of like 50,000 in India is a lot of money to be able to start a major business. And so grants have a huge role to play. And in fact, one of the things that we are experimenting with, we're in the midst of vetting a few applications now. We ran a innovation competition with the Rhodes Trust, which runs the Rhodes Scholarship. And basically, this was an innovation competition where we asked Equitech scholars, Rhodes scholars, Atlantic scholars to say, hey, come with a bunch of ideas around a particular specific domain. And if you kind of cleared the hurdle, and these are like very, very early stage ideas, we'll just give you a grant of, and might not be a large check, it can be like $10,000. But $10,000 for a lot of folks can be 6 months of like stipend so that they don't have to go do anything else, but like be heads down and develop a prototype so that they can then go raise that next round. So absolutely, the grants are a huge part of this philanthropy VC model.
What we see on the slide is like this reckoning is coming. And I say that without, judgment or prerogative, but as any new industry who has had a lot of power, we're starting to see some need for improvement. And I think one of the things, if we're concerned about the ecosystem, how do we create the environments for innovation to thrive, the environments for entrepreneurs to be able to opt in, the environment for our most pressing problems to really be addressed and to focus on those things, we need a healthy ecosystem. And I think VC is a very big player, has a very loud voice in that ecosystem, and we need some other diversity. So some of the great things we're seeing in the chat, things like grants, emergent ventures, these like state-owned funds. I think especially if you look outside of the US, like Europe has a ton of state-owned, government-operated investing funds that are doing some super interesting things. Great. I'm seeing a few other things in the chat. And so when we ask this question of like, what other models can we imagine? I think here's a short and certainly not exhaustive list of where to look, things that we want to see more of. And some of the things in the chat, do fit this. But angel investing in talent, there are some models to be tested about, investing in young people specifically. And in exchange, essentially for like equity of their future earnings. Now, I think there needs to be a lot of thought given to that and a lot of ethical parameters. But what are these other ways of investing in talent? I think there's a lot of. I think we are living in a moment, a macro moment of an important conversation, an important critique around capitalism. But if we believe that capitalism in its best form, its most useful form, is a contest of good ideas, how can we design systems where we're competing to win a meaningful game, and where we can get more competitors to the table? I think this motivates a lot of the work that we do at Equitech. How do we get more innovators working on these important problems? And then investing in the ecosystem as a whole. I think this is, again, something I hear a lot from a global innovation context, is like the local context, the local regulations, laws, the ease of doing business, super important. So what can we as leaders, as investors, do to affect that more the bigger macro environment of our ecosystem. And then we mentioned some of this prize money or like grants. Abhilash dropped some good references here. It's something we've certainly applied to. We keep our eye on. We see a lot of these things, but there are some really nice models. And actually, that type 1 diabetes, I think, is a good example of this. That fund of saying, here's this problem. We're going to put a lot of money toward it, and whoever solves that, that's where the money will go. And I think some of the strongest case for that is when we look at how much money is spent in VC based on like what the outcomes are, how much is lost, and what are the other ways that we could spend that. And then certainly this diversifying talent and deal flow pipeline. If you ask any investor, any investing 101 is like have a diversified portfolio. But we don't always see that in practice, certainly in terms of founder profile, in terms of geography, in terms of like life stage of the venture. I think I'm interested in seeing a greater appetite for this like sustainable business model and going for a volume play rather than unicorn hunting. So these are a few starts of ideas of things that we would like to see. And I'm hearing some conversation in the chat as well. My hope is that this is a list we can continue to add to. And I'd love to hear some thoughts from this group as well.
Thanks so much, Linda. I'm going to pause the recording.